Thank you. Thank you, everyone, for being here. It's nice to see so many people. I see we have a variety of students of different ages. Some of you, I can see your moms and dads peeking in from the background. That's good. They can watch. It's fine. I want them to know this is going to be quality material. And yeah, I see you laughing. Your mom's busted. Anyway, oh, okay, yeah, sure. So before we get started, I'll tell you that I've been working on Wall Street for about 15 years. I started out as an equity analyst at Standard & Poor's and covered a variety of sectors there. I was one of the first to introduce the REIT sector, the real estate investment trust sector. That's sort of my area of expertise. But I also covered a lot of consumer staples, some financials, consumer cyclical stocks, and these might be terms you haven't heard before, but they're all different sectors of the economy and different sectors of the stock market. And they're grouped together. We'll talk about that in a second. But after doing the analytical work for a long time, I got a job as a portfolio manager. And I managed several mutual funds, a large cap value fund, there was an energy fund, there was a real estate fund. And of course, we had some fixed income funds that I did work on as well, although I wasn't the manager of those funds. But fixed income means bonds and preferred stocks and things like that. These classes that we're talking about today are going to be mostly about stocks, though, not bonds, because that's where a lot of the best investments returns have been over the past hundreds of years. So let's get right into it. So I have some experience. I know what I'm talking about in this area. That's my point. So today we're going to talk about a bunch of different things. I'll give you a brief introduction to the youth investment classes that we have at VisWise Academy. We're going to talk about, what we do in our first couple of classes, and I'll give you like a preview of one of the first classes, and then we're going to sort of layer in some of the things that we do in the intermediate classes and the more advanced classes too, so you can get an overview of all the different courses we offer. And depending on what grade you're in, you may want to start with the first class, or if you're about to get into high school, you may want to start with a second class. But you can't really jump into the third class because they start to get pretty hard at that point. You need to have a little bit of background. We'll talk about that in a second. So we're going to talk about saving and investing. We're going to talk about why people should invest in the stock market. We're going to talk about the time value of money. These are all topics we go over in the class, and we'll go over them briefly today. We'll talk a little bit about how the stock market works, and we look at the stock track trading game. And no, that's not misspelled. That's actually the HTTP symbol right there. Stock, TRAK, not TRACK. Stocktrack.com trading game. That's the game we use to help people simulate managing a portfolio. And then we'll talk about some of the more advanced concepts that we get into in the intermediate and advanced classes, like sector asset allocation, talk about sectors of the economy, and we'll even get into macroeconomic analysis. We're not going to do any macroeconomic analysis today, but I'll tell you what it is, and we'll get to the point where we see what we do in the future classes and how you build layer upon layer. After you build a basic understanding of how things work, you can take it to the intermediate level and to the advanced level, and eventually you can manage a portfolio and do a good job at it. And hopefully you can make it into one of the teams where we do the Wharton Global Youth Stock Picking Competition. So VisWise Academy has right now about 4 different classes, and then we coach this last one, the Wharton competition. The first class we do is called Investment 101, and that's where you would start if you were in 6th grade. It's a basic class that talks about the time value of money and how business works and entrepreneurship and the concepts of saving versus investing. The next class we offer is called Invest in Your First Stock. And that's where students really start to pick stocks, they're using various techniques that we teach, relative valuation and intrinsic valuation. And they'll look at things like PE ratios and dividend yields and things like that. And then we get into intermediate equity analysis, where we actually start building a model and where we try to predict what companies are going to earn in the future. Because I emphasize this over and over throughout the class, nobody cares what a company earned last year if you didn't earn the stock. If you didn't own the stock then, that was the other guy's problem. You want to know what the company is going to earn next year, because if you buy the stock today, you're going to get next year's earnings, not last year's earnings. So That's when we start to get a little bit more advanced. And then the next class is sort of the preparation for the Wharton competition, investment portfolio management. And we talk about some more advanced concepts like how the different sectors interact with one another and how to diversify your portfolio better, and things of that nature. But we usually start out at a pretty basic level. We talk about saving versus investing because a lot of times people think saving and investing are the same thing, but they're not. Of course, you have to save money before you can invest. So they do go together. The problem is there's a big difference between saving and investing. And it comes down to the nature of money. And so this is US money. I'll show you some Canadian money in a second. But I'd like to talk about this money in particular because this is a special kind of money. It's a silver certificate. And what is money basically is it's a store of value. It doesn't really have, the value doesn't have any shape or form. It's, just a store of value. And you can use that value for buying goods, buying services, hiring somebody to do work for you, buying a PlayStation. You can use it for a whole bunch of different things. But it has value because it's agreed upon. Everybody agrees that $1 is worth $1. And everything is priced in Canadian dollars or US dollars. We all know what the value is because we agree on the value. The question is, why do we agree on the value of a dollar? And we talk about this a little bit in the class. We start talking about inflation. Well, here's the reason we agree on the value. Gold, okay? Gold and silver is the reason we agree on it. And that's why this is a special dollar, because if you look really closely at it, this certifies that there is on deposit in the Treasury of the United States of America $1 in silver payable to the bearer on demand. Okay, so countries all around the world, including the United States, have had bouts of inflation, massive inflation, hyperinflation. The reason we all agree upon the value of the US dollar is because it was originally, well, not always, but for a long time, for many, many years, including at this time in 1957, it was based on silver. There was silver, there was gold in the Treasury, in Fort Knox, in the Treasury building down on Wall Street right now. They still have gold in there. It's the Federal Reserve. And in the Federal Reserve Bank, they have all of this gold and silver, and that backs up and supports the value of the dollar. That's why we all agree upon it. You could literally take one of these dollars, go to the US Federal Reserve and demand, because it's payable to the bearer on demand, they would give you the silver. But something happened along the way. How it started, there's a gold certificate. For this one, you used to get $10 in gold coin. This is a gold certificate. But here's how it's going. It doesn't say anything about that now. Doesn't say anything about gold or silver. It's just a piece of paper. So luckily, we still agree upon the value. But because it's not necessarily strictly based on gold and silver, the government has a habit of pushing and pulling on the value of money. And that's what gets us to the value of money in terms of saving versus investing. And Canada is not immune to this. And I'll reemphasize this over and over. For all intents and purposes, if you see me looking at a US dollar, it equals a Canadian dollar. Not literally, but because there's this thing called the Bretton Woods Agreement, what happened after World War II, there was so much inflation before World War II, and countries were just printing money, and things were getting out of control, and they were competing on trade by trying to devalue their currency so they could sell more to one another. But after World War II, everybody decided to quit doing that. All the major countries got together in New Hampshire at a place called Bretton Woods, and they all agreed that the US dollar would be backed by gold and silver, like this one, payable in silver. All the other countries would use the US dollar as their reserve. There wasn't enough gold and silver to go around, so the other countries had some dollars, and they pegged their currency to the US dollar. So suddenly the world currency situation kind of stabilized, all the participants in the Bretton Woods Agreement anyway. So the Canadian dollar was strongly tied to the US dollar. It still is to this day because, of course, we do so much trade. But here's the thing. The gold standard didn't last forever. And the Bretton Woods agreement didn't last forever. And that's because, well, like I mentioned earlier, there wasn't enough gold to go around. There wasn't enough silver to go around. And also, countries, especially here in the US, but other countries as well, they kind of like to have inflation. But what that does is it erodes the value of savings. And here you can see they specifically reference the Bretton Woods Agreement, established the gold standard. We still had inflation, but gold standard is abandoned. And then we get down here with quantitative easing and the money supply growing by $3.8 trillion in 2020, equal to 20% of all dollars created. Yeah, governments like to print money, and that's bad for saving. It's very bad for saving because inflation is a real thing. If you put money under the mattress, eventually the value goes down. You can buy less stuff with it. So it's always better to invest because eventually the price of things keeps going up. All of the companies that participate in these services, hospital services, education, textbooks, college tuition, car insurance, medical care, they're raising their prices. That means they're making more money. That means if you bought stock in those companies, the stock would be worth more. But it also means that if you don't invest and you save the money, it's going to go down in value and you'll be able to buy fewer goods and services. So how's it going? Well, as I mentioned in that other chart, yeah, it's a little dicey. The governments are starting to print money again. Here's a chart. I just updated this today from the Federal Reserve Bank of St. Louis. You can pull this up and you can see that, yeah, they printed more money, printed more money, printed more money. One of the reasons they started doing this is because, like I said, the economy grew to the point where you would have to have a lot more gold to have more dollars. And there weren't enough dollars in circulation in the economy. So we abandoned the gold standard. But that kicked off a lot of inflation in the 1970s. We got it back under control, but now we have a big spike in money supply. The government, of course, will tell you there's no inflation, and they're lying to you. There's a lot of inflation. I'm sure you really know this if you're in Canada, because Canada exports a lot of goods and services to the US, mostly oil and timber, and the prices of both of those items have gone through the roof. So here's how the government kind of tricks you. They always tell you, don't worry, we got it under control. Everything's fine. So here, this light red line that you see here is all inflation. It goes up, it goes down. It tends to go down when there's a recession, which is these gray areas, right? But they trick you by taking out the things that actually go up and down. Most notably, food and energy. They're very volatile. And that's represented by this other line, which goes up and down a lot more. So they take that out. And when they take that out, it makes this red line here that looks like there's nothing going on. Nothing to see here. Nothing to worry about. Don't worry, the government's your friend. But sure enough, if you look at gasoline prices compared to the items that they show you, which is the fake numbers, you can see that it's very volatile. There is inflation and deflation constantly. The problem is the government doesn't like deflation. They like inflation, and Canada is not immune to this. I just pulled this chart up today from Trading Economics. This is a great website that we look at a lot when we're deciding how to trade stocks and where we want to invest. But for this introduction, we're just going to look at some Canadian information. Well, here we see when COVID lockdowns happened, producer price index, producer prices went down 4%, down 3%. And this is versus the same month in the prior year. But now, after printing so much money, oh, we're back to kind of normal numbers. Well, it's getting a little hot. Whoa, it's getting out of control. Woo! Canada printed a 9.4% inflation number last month. That's really, really high. I don't know how you guys are going to get out of this, but the US is the same. We are around this area, right in between here right now. And I'm pretty sure we're going this way. So if our inflation is picking up, you want to be invested in things that are going to enjoy price inflation, companies that can raise their prices, or items that will go up in value. And just to give you a brief lesson on why governments like to print money and they like inflation, it's because inflation is really bad, but The alternative is worse, okay? Deflation is the worst thing that can happen. Here, when you see, here's zero. If inflation goes below zero, that's deflation. You might recognize these dates as being commensurate with the Great Depression. When there's massive deflation, when prices start going down, it causes a lot of problems. Here's Japan in a more recent time period. As you may know, Japan had a bubble period where everybody thought they were going to get rich. Then they started having a little deflation, bounced back, but then they've had persistent deflationary pressures, and it's caused their economy to stagnate. And why that happens is because, think of housing. I like to use housing as an example. It's an easy example to understand. In Canada and the US, housing drives a lot of the economic activity. It's driving economic activity now, and it drove it for the entire pandemic when we were locked down. A lot of people moved out of the city. They wanted to get away from the COVID-19 virus. They wanted to get out of apartment buildings that were crowded, elevators, subway cars. They wanted to be out in an open space where they weren't going to get sick. So there was a boom in home building. And what happens when you build a home is you have to hire a lot of people and you have to buy a lot of goods. You've got to buy timber, you got to buy concrete, you've got to buy asphalt, you've got to buy glass, you've got to buy a washer and dryer, or a refrigerator, a microwave, air conditioner and a heater, and you have to hire carpenters to put that stuff together, plumbers install copper pipes, you have to hire electricians to install your copper wiring and your cable and your internet. You've got to hire architects, you've got to have a bulldozer on site to excavate. It's a lot of economic activity. And that really grows the economy. So how does that relate to inflation and deflation? Why am I telling you this, you might ask? Well, most people don't have enough money to just go out and buy a house for cash. They go to the bank and they tell the bank, well, I have 5% or 10% or 20% of the price of building a house. Can you loan me the rest? The bank says, yes, they love to do that because they'll give you what's called a mortgage. And a mortgage is a loan, but it's a special kind of loan because you hold the house as collateral against the amount you borrow. If you don't pay back the money, the bank will take the house and sell it and use the proceeds from selling your house to pay off the loan. If there's money left over, they give you the money. If there's no money left over, well, the bank lost money. So how could that happen? In an inflationary period, prices go up. If the price of your house keeps going up and you lose your job or you quit paying the mortgage, the bank takes the house, it's gone up in price, they sell it, they pay off their loan, and they give you the rest of the money. If there's deflation, it's the exact opposite. The price of the house went down. You lost your job. You quit paying the mortgage. The bank takes the house, it sells the house, but it's worth less. It's worth less than what you owe on the loan. And if that happens, it's really bad for the economy because the bank will lose money on the loan. And if they start losing money on loans, they quit making loans. If they quit making loans, nobody else is building a new house. Nobody's hiring architects. Nobody's hiring excavators, plumbers, electricians, roofers, carpenters. None of those people get hired and none of those goods get purchased. If nobody buys microwave ovens, the microwave oven factory closes down. Nobody's buying washing machines, the washing machine factory closes down. If the washing machine factory closes down, they're not buying steel to turn into washing machines. So the steel plant has to lay people off. If the steel plant lays people off, they're not buying iron ore from Canada. So the iron mine is closing down or laying people off too. It's a deflationary spiral that's terrible. And that's why governments love inflation. If they're going to have inflation or deflation, they always err on the side of inflation. But what does that do for the time value of money? Well, that's an interesting thing. We'll look at that. Here's a kind of famous chart. I believe it comes from the French Fama Factor Model website, where they look at total real return indexes. And this shows you in graphic terms the difference between saving and investing. Because had you saved $1 back here in January of 1802 and just stuck it under your mattress or put it in your piggy bank, the value of it went down and kept going down and kept going down until it was worth less than a nickel. It's worth zero dollars, 4.9 cents. That's what happened because of inflation. That's what happens if you save money, unfortunately. Investing it in the bank isn't really investing it either. Usually banks will pay approximately the rate of inflation, maybe a little more, maybe a little less. I think some of the highest interest rates on savings account in the US right now are about 0.5%, maybe 0.6%, but inflation is running a lot hotter. That's why you should invest in other things, like stable things like gold, which held its value, T-bills, bonds, that's loans to companies, or the best one of all, stocks. And that's why we talk about investing in stocks more than anything. Okay. Yeah, so that's why we talk. I got a message on the message chat, so I had to read it. So that's why we talk about investing in stocks. It's really important that you understand how to invest in stocks, because the two best ways it's the same way actually. The two best ways to get rich are start your own business or to invest in stocks, which, by the way, is the same thing. If you invest in stocks, it's investing in a business. As an owner, you will be the owner of the business. So as you can see here, the same $1, had you invested it, it would have grown over time to $1,136,042. That's a big difference. And this is in real returns. That's why we talk about inflation first, because real returns means you subtract the inflation from the value. $1 here is going to be the same. It's going to be $1 here. But if you subtract inflation from it, that's why the value goes down. You subtract this, stocks go up 6.7% in real terms. But if you don't talk about inflation, it's actually a long-term average of about 10 to 11%, depending on the time period you're looking at. That's really big. 10 to 11% returns is pretty huge. That's why everybody likes to invest in the stock market. So we kind of start the introductory class by talking about small businesses, so that you get an idea of how business works and how investing in stock works by investing in the stock of your friend's small lemonade stand, or maybe a snow shoveling business. I know you have a lot of that in Ontario, or maybe a lawn mowing business in the summer. And what we do is we take you through the very basics of things like, how does that work? How do you analyze a company? And we start from the very basics by talking about things like an income statement. And we talk about, how to analyze things like this, like sales and cost of goods sold. What is it? Well, sales are the money customers pay for the lemonade your friend sold. And the cost of goods sold is the cost of items used to make the thing. So like lemons, sugar, cups, water. You've got a pitcher. Gross profit is you subtract the cost of goods sold from the sales and you get the gross profit. And we walk you through all these different items that you would see on any income statement for any company that's traded in the US or Canada, like Apple Computer, like Tesla, like Shopify, like Canadian National Resources. They all have these same items in their income statement. And then you're going to look at these things and decide, is this a stock I want to buy, or is this a stock I don't want to buy? What's the value of the stock compared to the value of the company? And we'll take you through all these different things. And we'll talk about the time value of money. And what you do is you look at the earnings and how they're growing and kind of figure out what the stock is worth. And we'll show you exactly how to do that. We'll talk about all kinds of intrinsic and relative valuation techniques. But let's talk about math for a second. We teach some math. We teach the equations for the time value of money and other things. But I always tell the students, math is for making money. Don't be scared by the math. There's not going to be a test. I don't want you to memorize the formulas. I mean, you can if you want. I'd be happy if you did. But I'm not going to give you a test on these formulas, because life is an open book quiz. You can always go on the internet and look up the formula if you don't remember exactly what it is. Everybody does it, right? So the point I want to make, though, is that I want you to understand the concept. If you understand the concept, you can always look up the formula and figure out how to use it for whatever problem you're trying to figure out. But I want you to know that when you're in math class in school and your teacher's talking about things like exponents or square roots, And you're going, why? Why do I have to learn this? Why? When am I ever going to use this in real life? Well, I'm telling you, you're going to use it in real life because it's for making money. Okay, that's what that stuff is for. Your math teacher might not even know that. Your math teacher might just know how to teach math and not know what it's really used for in real life. But I'll tell you what it's really used for. You use things like algebra and calculus to figure out how much money a company is going to make and to figure out how much a stock is worth. That's what you can use it for. You can use it to make money. So don't be the kid in math class who's going, why do I have to learn this? When am I ever going to use it in real life? Let the other kid be that kid. I want you to know that when your teacher's teaching this stuff, even if they don't know what it's for, you will. And we talk about the time value of money. We start really graphically like this with actual pictures so that it's easy to understand the concept. And I'm not going to go through all the details, but this is a basic representation of, after your friend wanted to build that lemonade stand, asked you for an investment, you invested $100, and she promised to pay you a return of 10% per year, compounded annually. And what the plan is you're going to run a business, and you couldn't participate in the business with her, but because money is a store of value, you can participate by investing your money. The plan is you're going to run your business throughout high school, then you're going to sell your businesses and go to college. So this is sort of a graphic representation to help you figure out and understand the concept of the time value of money. And that is that if somebody promises you a 10% return, you would get $10 every year, right? That's it, $10 every year. But no, that's not how it works. When you compound interest, or you talk about the future value of money, what happens is you earn 10% return on $100 earns $10 in the first year. But in the next year, the $100 earns another $10. But the $10 you originally got also earns $1, because 10% of $10 is $1. In the next year, the $100 gives you another $10. That's 10% of $100. The first $10 you earned in the first year gives you another $1. The second $10 you earned in the second year gives you another $1. And the $1 you earned previously gives you a dime. The same thing happens, not to belabor the point, we'll just get straight to it. You get this, and the dime eventually pays you a penny. If you keep going on, you can see that here's the thing about compound returns. It gets bigger every year. The amount you earn gets bigger every year. The amount you earn gets bigger every year. The longer you can invest, the more your returns compound, and it gets to the point where you're making more than your original investment every year. So we get to the math, and we discuss the math. I'm not going to get to it too much here. This is simply representing the same thing we just saw in the graphic slide, but it represents it with numbers. And we break it down, and we talk about how this works. $100, and then the next year you get 10%. So it's times 10 plus the rate of return, 1 plus the rate of return, and that gives you $110. And then you do the same thing, times 1 plus 10% rate of return, blah, blah, blah. And then there's a shortcut. And here's the future value. And I'm not going to teach you what it is today, but I'm going to tell you, we do teach these formulas, and we explain them in great detail. So you can figure out what the future value of money is. FE is the future value. And the future value of money is the present value times 1 plus the rate of return raised to the power of however many years you're investing. This is where your math teacher may not know what this is for. These exponents, they'll teach you exponents, they'll teach you algebra, they'll teach you square roots and cube roots. They might not tell you what it's for though, but this is what it's for. If you make an investment today, you can figure out what it's going to be worth by the time you want to buy a PlayStation, or by the time you want to buy a car, or by the time you go to college, or by the time you want to buy a puppy, or by the time you want to buy a house, or by the time you want to retire, which is a big one for a lot of people. You can figure out exactly how many years it is till you're going to make that purchase. And you can figure out how much money you need to invest today. Well, present value, so that you can get the amount you need. You can use this for real life. So after we do that in our introductory classes, we talk about why you should invest in versus save, what the time value of money is, when things like that. Then we start talking about how to actually invest in companies, and the best way is through stocks. And we'd start talking about stock analysis. I'm going to share a different screen now so we can look at stocktrack.com. Give me a second. I have so many screens open on my computer. There we go. So here's one. This is what the introductory screen looks like. We can go to the dashboard, and I've got a whole bunch of different classes that I'm teaching this semester. So we have all of these different ones. And we can see that things like there are announcements, there are forum posts, there are the top traded stocks, Disney, JP Morgan, S&P 500 ETF, Apple, Tesla. These are pretty popular ones for most investors. And here's another class. It's kind of similar, I'm sure. Oh, they like Tesla more than Apple. Chevron is big in this one, and Boeing. Well, that's Bank of America. Here's Boeing. And we can compare each other's portfolios. We can see how everybody's doing and see what they're investing in. So in this class, we've got a whole bunch of participants, and we've got 37 participants. And some of the kids are more active than others. You can see Kevin here had 59 trades. He's up. I mean, most of the students do really well in this class. You can see all the things he's invested in. He bought a whole bunch of different stocks. Some did really well, and some didn't do so well. He bought some meme stocks, unfortunately. I always try to tell the kids not to do that. It's a little bit dangerous. But some of the students build really basic portfolios. Here's a student named Alan, and he's only made 9 trades. And let's see what he bought. United Healthcare, Tesla, Pfizer, Netflix, Johnson & Johnson, Goldman Sachs, Amazon, and Apple. So he's got some technology names, some financial names, some healthcare names. That's a nice, well-rounded portfolio. It's well diversified, and he's doing really well. Most of the students do great in this class based upon the advice we give them, because we teach them, keep it simple. Invest in the things you know. And diversify. And we teach you different techniques for diversifying. So when you sign up for one of these classes, we're going to send you some logins, and you can join one of these classes, and you can go in here and start trading stocks. You can go in and start buying stocks as if you had your own brokerage account. We give you $1 million. So it's like you're an institutional mutual fund manager or portfolio manager or a hedge fund manager, and you can buy or sell stocks. And let's say I want to buy, it's suggesting I buy Google. So let me get some Goog, which is Alphabet's, the parent company, and I want to buy 100 shares. I probably don't have enough money. It'll warn me that because I've already invested too much. So let's say I'll just buy 20 shares. You know what? Let's do this. I'd rather buy Apple. I'd rather buy Apple today. Let's just buy 10 shares of Apple. And you can preview your trade, and it'll show you how much it's going to cost you. And then you click confirm. And what happens, it will be added to your portfolio. And this whole system keeps track of what your stocks are, how much you paid for them, and it's just like you're really investing the money. It shows how many shares you own, what the price was you paid for them, how much, what's the price now, what are you up or down by what percent, and this is how it keeps track of it for you. So this is a very realistic way to keep track of stocks and pretend you're investing in the stock market for real. It's a great way to sort of invest. And what we do is we have a game. It's a contest. And the contest is, of course, whoever wins, not including me, of course, because I'm the teacher, we all get a certificate, but then we give away prizes too, usually gift cards. And so like top several of these students have done really well. They'll get a gift card. And of course, some of the students don't do so well, but they all learn something, and they can all talk to their mom and dad and say, hey, look, I didn't lose money. I can invest in the stock market. I know what a PE ratio is. I know what a price to sales ratio is. It's something I can do. And maybe one day they'll let you open up a Robinhood account or another account, an E-Trade account, or a TD Ameritrade account is one of the big ones in Canada. I saw there was a question in the chat, but my chat doesn't want to open, so I'm sorry, I can't see it right now. Oh, there it goes. Apple asked me, don't people usually buy like 100? Yes, that's true. Usually you buy around lots of 100. Traditionally, that's been the case. In the old days, you almost always had to buy in increments of 100 shares, but not anymore. These days, with you can buy fractional shares, believe it or not. The stock market has gotten so efficient. You can buy one stock, you can buy two stocks, you can buy half a stock, and they just aggregate orders together. It's kind of weird how it works these days. But in my case, my $1 million was almost fully invested, so I couldn't buy 100 shares. I could only buy a couple, so I just bought fewer shares. That's all. Anyway, that's how that works. It's a lot of fun, and we talk about it every class. We see who's doing good and we see who's doing okay. We talk about different strategies and talk about why somebody's doing better or not, and who's more diversified and who had the best stock picks. But we do things like this. We start with $1 million. We're long only, which means you can buy stocks and then you can sell stocks that you buy. There's no short selling. That's more of a hedge fund game, and we don't get into that yet. No penny stocks. So the minimum stock price is $3. We do pay interest. So if you have some cash, I don't want you to, lose all interest in the game. If you have some cash, we'll pretend that the bank is paying you 2%. Trading commissions are $10. That's kind of realistic if you use a real broker. Some brokers are more expensive, and some, like Robinhood, are free. But no more than 10% of your portfolio in any one stock. And this is something that we really talk about a lot in the class, is how to stay diversified. And it's important to stay diversified. When you talk about stock picking, you want to pick stocks that are not all going to go in the same direction at the same time. Because if the market goes down, they all go down at once, you're going to get hurt really badly financially. And we have the rule so that you can only put 10% of your portfolio, because if you put all of your portfolio into one stock and that stock happens to go down, you've lost the game and you didn't do a good job. So we start talking about things like bottom-up approach and a top-down approach. And we teach both of them over the course of our several classes. What a bottom-up approach is when you look at different companies in an industry and in the sector, and you compare them to one another. Is one growing faster? Is one more profitable? Is the stock more expensive than the other? And you look at those and you decide which one of those companies is the best one in that sector or in that industry. We also start by teaching the top-down approach, because it's one of the best ways to learn how to diversify your portfolio. And with a top-down approach, you go from the opposite end. It's like the view from 10,000 feet. The first thing you do is you look at the economy as a whole. And how's the economy doing? And based upon how the economy is doing, which sector of the economy is going to do well versus which sector might not do so well. It's really easy to tell sometimes. When COVID hit and we had lockdowns, well, obviously, hospitality sector and leisure sector, hotels, restaurants, bars, not going to do well. Retail, not going to do well. Healthcare, probably going to do okay. Stay-at-home stocks for people working from home, technology stocks, probably going to do great. People staying home need a new computer so they can work from home using Zoom. They're probably going to watch a lot of Netflix. Those are the kind of industries that are going to do really well in that environment. So you think about what's going on with the economy at any given time. You figure out which sectors are going to do well. And then you figure out which industries are going to do well. And then you start looking at different companies within those sectors. So there are two different approaches. Usually I like to start with this, the top-down approach, and then do the bottom-up approach, because after you decided what sectors you want to be in, then you look at the companies within the sectors and compare them to one another and see which one's going to do better. That's a great way to start picking stocks. But it's also important to do the top-down analysis, because there are so many different sectors and they don't all move the same direction at the same time. That's a key thing that we talk about a lot in the class. I'm not going to go into it too much, but it's a thing called correlation. And one of the first things I teach students to do is that if you went out and you bought your first few stocks and they were in, let's say, technology, which is the largest sector, which is this big slice of the pie right here, represents 26% of the stock market. Well, go out and buy something in a different sector that's also a good company, but it's not in the same sector as the one where you're invested. It's in one that's not correlated with that sector, so that when your investment goes down, the other ones will probably go up. And some examples might be healthcare sector, which is this one. Very stable sector, not as volatile as the technology sector. Or consumer discretionary, which is very volatile, does well when the economy's growing, doesn't do well during recessions. Financials, that's trades based on interest rates. That's your banks and your investment accounts. Communication services, that's not only your cable and your internet, magazines, but also things like Facebook and Google, because these are things we used to communicate with one another. That's a pretty big slice too. They're actually tech related for a lot of these. And you've got industrials, they make things. Then you've got consumer staples, the things that consumers buy that they need, that they don't stop buying, even if there's a recession. Things like food, things like beverages, packaged foods and beverages are the things people are going to keep buying, even if they quit spending all the rest of their money on anything else. Energy, which of course is very volatile because it's tied to the commodity prices like oil, and basic materials, which is mining and things of that nature. Utilities, such as the water company, the electric company, the phone company. You've got things like your cell phone provider. And then, of course, you've got real estate, which is office buildings, shopping malls, grocery stores, not the store themselves, but the building and the land that they rent to the grocery stores, things of that nature. These are the 11 different sectors of the economy, the 11 different sectors of the S&P 500. And we talk about how to diversify your portfolio by buying something in these different sectors that you think will do well. Let's say you think information technology is going to do well, and you think, let's say, energy is going to do well. Well, they're not that correlated, so you should buy some stocks in each, and you should spread out your investments and buy things that will help you stay diversified. Because if you start investing in stocks and you don't look at things this way, a basic mistake that a lot of people make is they all go for something exciting that went up a lot last year, like information technology. Everybody knows tech stocks did great last year. This year, not so much. They haven't done a whole heck of a lot in the last 6 months. But we teach you, stay diversified. Get into these different sectors. Get into these areas that aren't correlated with technology. It's okay to invest in technology, but don't put all of your money there. And then we start talking about how to value these stocks from a bottom up. And we start talking about things like price to earnings ratios, price to book ratios, price to sales ratios, price to cash flow, and things like that. This is just clipped from the S&P 500. So these are the sectors again, and these are the actual marks for the S&P 500 in terms of price to book ratio and price to earnings ratio, 27 times. It's a little out of date. And we talk about how sectors perform differently over time. Here we see technology is this black line. It did really well during COVID lockdowns. Energy went down and stayed down. It was like a boxer who got knocked out, flat on his back on the canvas. But from this point forward, from right around here, you can see technology hasn't gone up as much and energy is starting to rally. Same with financials. That's what we've seen this year. Facts change, economic facts change, and when facts change, you got to change your mind. And you have to start investing in things like financials and energy. Even if you think technology is great and exciting, technology isn't doing as well anymore. And how diversification works is a great example. Is let's say there are two businesses. One makes umbrellas, company A, and one makes sunscreen, company B. Well, what a lot of investors do, unfortunately, is they'll buy company A, let's say umbrellas, and let's say it's sunny, and company A's stock will go down, and sunscreen company goes up, and they'll be like, oh my goodness, I'm losing money. The other stock is doing great. They'll sell here and buy this. They'll buy this company B, the sunscreen company. And then it'll get rainy and the sunscreen stock will go down, but the umbrella stock will go up. And the novice investor will say, oh my God, I'm losing money. My stock's going down. I need to sell and buy this other stock that's been going up. And you end up getting returns that look like this. The point is, if you don't put all of your eggs in one basket and you stay diversified, if you put half of your money in company A and you put the other half of your money in company B, you get the returns represented by this orange line. You get all of the returns, but you take a lot of the risk out. You can improve your returns and diversify away the risk. This is something we teach in one of the earliest classes, but it's one of the principal tenets of portfolio management. Buy things in different industries and different sectors. Make sure they're good companies, but then stick with them, because when one goes up, the other goes down, you're still going to get good returns. If they reverse, you're still going to get good returns. If one of them goes against you, but the other one does great, you're still going to get good returns. It's important things to learn. So I'll just go through these next few slides very quickly, because we're going to start talking about what we do in the more intermediate and the advanced classes. So this is one that we do in Invest in Your First Stock. We start looking at the analysis of financial results. In the introductory class, we keep it simple with things like your friend's lemonade stand. And we introduce the concept of what is a financial statement, what is a balance sheet, things like that. Then we start looking at actual companies. So we look at things like calculating the rate of change when a company issues its quarterly earnings report. Are they growing faster or slower? Are things getting better or are they getting worse? We compare their year-over-year results to prevent seasonality distortions, and it helps us learn what happened in the previous quarter versus the prior year. And it looks something like this. In this case, we did Apple. We talk about real companies. This is what Apple did. Their products they sold 50, that's probably billion, versus, now this isn't the fourth quarter, so this was done before they put out the iPhone 12. These numbers went up a lot when they introduced the iPhone 12. But we look at what they did in the quarter in terms of their sales, in terms of their costs, and we get their gross profit, and we compare how did it do. We calculate this section here. Did it go up or did it go down? And we learn how to calculate things like the gross margin. Is this company profitable? Did their gross margin get wider or did it narrow? In this case, even though this wasn't the best quarter ever for Apple, the results are great. The company's really profitable. 38.2% gross profit is really, they're making a lot of money. And the amount of money they're making is going up. Their gross profit increased 1.5%, even though they hadn't introduced the iPhone 12 yet. When the fourth quarter numbers came out, this went really gangbusters. And their gross margins got better, so they're getting more efficient at what they're doing. And after we learn how to do that, we look at things like relative valuation. If there's a case like the Ford and GM, and you're interested in investing in this industry, you have to figure out which stock is more expensive. And if you're a novice investor, you probably look at it like, well, this one's $45 and this one's only $9. So obviously the $9 is less expensive, right? No, that's not how it works. You don't even know how many shares they've issued. I mean, maybe Ford only has one stock outstanding, and if you buy this stock, you own the whole company. Maybe General Motors has 10 billion shares outstanding, and you're just like wasting money buying this. But there are ways to figure that out. So we talk about things like price to sales, price to book, and we standardize the stock price by using ratios like the PE ratio, which is literally the P, which is the price, divided by the E, which is the earnings per share. And so you can see by doing some basic calculations, the price of Ford is only $9, kind of cheap, but their earnings per share is $1.05. If you divide the $9 by the $1.05, you get 8.66 times. You're paying 8.66 times earnings, or $8.66 for every dollar of earnings. General Motors is $45. It looks like a more expensive stock, but they're going to earn more money, $5.86. So you divide these two and you get 7.86 times. It's a lot cheaper stock, even though the price is higher. This is the more attractive stock to buy in this case. And here's one thing I'll emphasize to you now that we talk about a lot in the class, and I mentioned it earlier. This is EPS 2021 estimated. Don't look in the rearview mirror when you're driving a car, and don't look at what happened last year when you're trying to figure out if a stock is expensive or cheap. It doesn't matter what the last guy paid for the stock. He owned it last year. You want to know what they're going to earn this year and in future years. So we look to the forward earnings estimates for calculations like this. It's important to remember that. But then we're not going to get too much farther in this introductory class. But what we do next is say, well, what do we do now? So we've got GM, we figured out, is already cheaper than Ford. So you'd rather buy GM. But Tesla, everybody loves Tesla. They're only going to have $3 of earnings. And this is obviously old. The share price is a lot higher now. Their PE ratio is 150. Well, so there's something else going on. And we start talking about alternative ways to figure out what the value of Tesla would be relative to GM or Ford by introducing things like the price to earnings to growth ratio, or otherwise known as the PEG ratio, or the price to sales ratio, which is really useful for things like technology companies. And we'll introduce all of these different concepts. And as we go along through the courses in different classes, we get into more advanced concepts. I'll mention a couple of them here. And we start talking about industry analysis. So when we really dig into the stocks, we can really compare them to one another. So we've already looked at things like figuring out the operating margins of companies. Here's the gross profit of Coca-Cola in the fourth quarter of 2020 and the change. And we start looking at things like, what is the gross margin? Did that increase or decrease? What's the operating margin? Did it increase or decrease? What was the net margin? Did that increase or decrease? And we look at all of these different things. And you can see here, net income is down 28%. Coke had a terrible year last year. They were just awful for a lot of different reasons. But the point is, we start looking at different companies in the same industry, because then you can compare them to one another. You can see what the EPS growth was for all of these companies. Well, Keurig Dr. Pepper looks like it's doing great, while Coke looks like it's doing terrible. You can see if they're getting more profitable or less profitable. You can see what is their debt ratios. We'll talk about all those different things. What's their return on equity? And you can see that some of these companies do a lot better than others. So we start comparing different companies to one another in the same industry, not just on stock valuation, but which one's growing faster. And then in our last classes, in our last courses, we start talking about portfolio management and great ways to build a better portfolio that's going to outperform the market and have less risk. And we start talking about all kinds of different things like correlations. And we talk about how to actually calculate these things. And here we did a correlation chart for all the different sectors. You got technology sector, communications, financials, healthcare, consumer, all the sectors we talked about before. I'll show you how to actually build this. And don't worry if you don't have Microsoft Excel, it's not a big deal. I'll tell you how to find it in Linux computers, or Mac. Microsoft has Excel. Mac has, what is it called? Pages. There are Google Sheets if you don't have any of those systems. Linux has LibreOffice. Doesn't matter. Even if you have a Chromebook, you can just go on Google, make a Google account for your Gmail or whatever, and they have these apps for free. There's a free spreadsheet you can use, and I'll show you how to do all the calculations and formulas. And you can see how we've color-coded this one. So you can see where there's correlation and where there's not correlation. And it helps you make better decisions for your portfolio management. And we could talk about things like beta. And beta is a weird thing that shows how much does your stock portfolio go up when the market goes up. If the market goes up 10%, well, consumer cyclicals is going to go up 15% because it's got a beta of 1.5. If the market goes down 10%, something like industrials would only go down 6% because it's only got a beta of 0.6. We explain how all of these things work and how it can help you make decisions to decide what industries you want to be in, what sectors you want to be in, and how to pick the stocks and compare them to one another within those industries and sectors. That's why people do pretty well in our class. When I showed you the stock track, most of the students make money. Almost all of them do. And I think they should be proud of themselves. I'm proud of them. I think a lot of them have learned a lot by taking these classes, and they're able to manage portfolios. They're able to show their moms and dads that they can figure this stuff out for their own, that they're big enough to do it, they're old enough to do it, and they can prove it by showing, hey, look, Mom, I made 10% this month. It's better than your portfolio. So I don't know. Think you can let me open a stock trading account? But basically, that's what we teach. So we take you from step one to the intermediate steps to the more advanced steps. And if you stay with us, stay through the courses, you're going to learn a lot. And hopefully you'll be around long enough to join one of our teams that we coach through the Wharton Global Youth Stock Investment Contest. I think that's what it's called. They have a very long name for it. But that's it for me. I'm about done. So
awesome.